Did last week's job numbers just signal a warning for the economy? Stick around because I'm breaking down the data, what it means for the market, and what's next for the Federal Reserves. If you care about your wallet, you can't miss this. My name is James Santiago and you're watching Learn Wealthy. So last week, we saw some critical labor market data hit the headlines, starting with the November Employment Situation Report. The US added 227,000 jobs, a solid rebound compared to prior months. However, the unemployment rate ticked up to 4.2%, raising some eyebrows. So if you've been watching this channel, you know this chart, the 10-year and 2-year Treasury yield curve. So we know that before a recession, we get an inversion of the curve where the short-term Treasury makes more yield than the 10-year Treasury. It's basically when this blue line goes below this black line, we get an inversion. And then it uninverts where the blue line goes back up again past the black line. And then we get this gray bar, the recession. And that's been happening recently where we have a massive inversion. And then it recently uninverted, so we could potentially be expecting a gray bar here, or a recession. And you know what happens during a recession? This is 2008. This is the unemployment rate chart. So during the recession, we're back here at 2008 gray bar. During the recession, that's when the unemployment rate creeps up. So you got the inversion of the curve right here. We got the uninversion, and then unemployment rate starts creeping up. So we just had a massive inversion right here, and we had the uninversion. And it seems very similar that now too, the unemployment rate is starting to creep up. But we're only playing with probabilities and not certainty. And historical data is saying the probability of a recession is really high. Wage growth also remained tepid at 0.2%, potentially signaling a cooling of inflationary pressures. But that's not all. The job openings and labor turnover survey, the JOLTS report, for October also dropped last week. It showed an increase in job openings, suggesting employers are still hiring, but layoffs decreased, signaling some stability in the labor market. This mix paints a complex picture. While opportunities are growing, the rising unemployment rate could mean more people are competing for jobs. So here's why this matters. For the Fed, with slower wage growth and rising unemployment, the Fed may feel more justified to cut rates further. For businesses, higher job openings and fewer layoffs suggests resilience. But companies could still hesitate with hiring if economic uncertainty continues. And for us, a cooling labor market could mean more competition for jobs, slower wage increase, and less spending power, all of which could ripple through the broader economy. So, is the labor market signaling a recession, a slowing down of the economy, or just stabilizing after the near recession we had back in 2022? Remember the First Republic and all the other banks? Only time will tell, but one thing's for sure. These numbers will shape economic policy and market movements in the months to come. A few important dates we need to watch. December 18, we got the Federal Reserve interest rate decision at the FOMC meeting. They're going to be using the labor market data we just talked about in this video to decide if they're going to continue cutting rates. December 11, Consumer Price Index or CPI report from the U.S. Bureau of Labor and Statistics will release data for November providing insights of the inflationary trend. December 17, the U.S. Census Bureau will report November retail sales figures, offering a glimpse into consumer spending patterns during this holiday season. And you know we're going to keep you posted here at Learn Wealthy. So for more finance, investing, real estate, and macroeconomics, let's all learn wealthy together. I'll see you in the next video.